Yeah, that's a really interesting question right now. I think it's the question that everybody's asking, and I think we have to look at it in a number of different ways. Which is that we don't really know what the outcome of the Russian special operations is going to be. We actually thought that it was all playing out pretty much along the lines that we'd expected. We published a paper in January telling everybody to be aware of all the risks in Ukraine. And initially it seemed that things were going along with that. But then we had, after the first wave of sanctions from the West, we then had a second wave of sanctions, which I think was probably a little bit of a surprise, just the sheer force of it. And things like cutting Russia off from the SWIFT payment messaging system, things like confiscating Russian reserves. And I think that potentially is a bit of a game changer. So I think what we have to do is try and break things down into kind of first order reactions from the events we're seeing, and also kind of systemic reactions. That there's once all of this finally resolves itself in some way or another, then that won't be the end of it. There'll be a lot of longer term lingering implications that'll be really potentially serious for the shape of the financial system for many years to come. This could be a really game-changing event over the longer term, but it'll also be very, very significant and very volatile in the short term. I think it's really interesting from a scenario point of view is that most people are focusing on the idea of will the conflict will it end fairly quickly, or will it become prolonged? We don't know that. It could be either of those things. But actually, I don't think that is the important question. It's the thing that everybody seems to be getting hung up on. But actually, we don't think that's the important question. We think it's more to do with, if the conflict gets resolved, well, what are the terms of that resolution? If the conflict drags on, well, what are the terms of the conflict? These are going to be the things that really define what happens from here on. Will there be a change where instead of having essentially a unipolar financial world where US dollar is the reserve currency, where pretty much everything revolves around US capital markets, will there be a real change in that? There's a very significant risk that actually what we're seeing now could end up creating a very big shift away from a US-centric world into a multipolar world, that actually everybody's focusing on the damage to Russia, and there is a lot of damage to the Russian economy. And obviously also the most important thing here is that there are big losses of life. The Ukrainian lives, Russian lives being lost during this conflict. But in terms of scenarios for more significant financial and economic impacts, one of the things we have to look at, and Michael Hudson, who's a really eminent economist, probably one of the most intelligent people on the planet, wrote a paper saying that actually this could be the beginning of the end of the US dollar dominated, US capital market dominated system. And if so, that would be the biggest change in anybody's lifetime from a financial and economic point of view. I think a lot of people are again not really fully understanding. So we've seen much higher oil prices, we've seen much higher commodity prices generally, and that's because what we're really experiencing now, what we're living through, is another version of a supply shock. For us, all the inflation that we've seen over the last year or so has really been about supply. It's been about disruptions to supply. It's not been about a sudden increase in demand. In most areas, demand is lower than it was going into the pandemic. So we actually have a weak economy, but we have really disrupted supply lines. And the difficulty, I think, is that policymakers, particularly in the States, have really backed themselves into a corner by saying that they're going to deal with this supply shock driven inflation by applying the kind of remedies that would really only work, if at all, to demand-driven inflation. So we've got a Federal Reserve, we've got a Treasury in the States that's committed to really tightening in a way that's going to potentially hurt economic growth, and we certainly see the risk to economic growth as being very severe, but also in a way that could cause real problems in capital markets. We're already seeing that there's much less liquidity floating around, and this is a time when actually policymakers should be ready. They should be alert to go and introduce huge amounts of liquidity into the markets. We saw something very strange happen in the London Metal Exchange the other day, when the price of nickel, just in the space of a few days, increased fivefold in fact, and that actually created such big shocks in the system that the LME, the London Metal Exchange, had to go and unwind a whole day's trading and pretend that it hadn't happened, because if they didn't do that, it would have been a real risk to the survival of a lot of businesses. Now, there's a lot of talk about why this was done, because a lot of the businesses that were under threat were in China, and the London Metal Exchange is actually owned by the Hong Kong Exchange. So people are saying, well, maybe there's some kind of behind the scenes shenanigans or whatever here, but actually that's not the point. I mean, there may well be, we might never know that, but the point is that there are really systemic risks out there where businesses, banks, even whole sectors, even the financial sector, are really at risk because of the lack of liquidity, because of Fed policy, at the same time that the whole economy is at risk because of lack of liquidity, because of Treasury constraints. In the United States this year, there's going to be around $1.5 trillion less net funding than there was in fiscal year 2021. So all of these things are, they're really alarming. These are huge risks that we face that were problems before the conflict happened in Ukraine, and the conflict in Ukraine has potentially changed them, and certainly the response to the conflict and the policy response to the conflict has changed those from being problems into becoming real systemic risks. Yeah, again, great question. So, looking back to what I was saying just now, the first thing you have to do is try to identify the range of possible risks. Understand that, in this environment, almost anything can happen. And it's not just binary. It's not about, will the conflict finish quickly? Will it take a long time? As I said, it's about the terms that the conflict is conducted on, the reactions, the secondary events, and it's also about these kind of long-term implications, the damage that's being done right now, the way that's going to keep affecting things for many years to come. So trying to understand all of those and understand what the implications are for all of those, that has to be the starting point. Typically we and other commentators might say, oh, we think this is going to happen, or we think that's going to happen. Right now, I don't think it's very useful to try and create forecasts like that, because nobody knows what's going to happen. So what we have to do is look at all the scenarios and try and make sure that that clients aren't exposed, portfolios aren't exposed to those worst possible outcomes, and we have to try to mitigate those risks and hedge those risks. So I think just understanding that nobody knows what's going to happen from here, the range of things that could happen is way more extreme than at any other time in our lifetimes, and we have to try to be aware of all those possibilities and hedge against the bad outcomes, prevent the bad outcomes. Now, that might mean that portfolio returns are going to be a little bit lower, because actually it's really like buying insurance for your portfolio. Every time you make some form of hedge, it's compromising the return from your portfolio. But you know what? Right now, we can't afford to be aggressive in chasing returns. Nobody should be aggressive chasing a particular scenario, a particular outcome. They shouldn't be trying to get the highest returns they can, unless they're willing to lose everything. Because in this kind of environment, as I say, anything could happen. And so the more that you protect against different outcomes, potentially the more cost that has for a portfolio return. But to us, that's the really, really important thing right now. It's much more important to be safe and to be sure and to be protected against all outcomes than it is to just follow your gut feeling and bet the farm on a particular outcome that might or might not happen. That's the way we should approach things at all times anyway. We should have good risk management, but right now it's really shining a light on who does have good risk management and who doesn't, and portfolios that have good risk management and that try to prevent all the possible bad outcomes, those are the ones that will be resilient.
Thank you.